5,000 is an absolute minimum for gold, but I think that's even silly. I think we're going to be seeing $10,000 gold. Well, at a 20-to-1 ratio, that's $500 silver. And nobody thought that a gold-silver ratio of 14 was achievable. But when the bull market in the 80s, the 70s started, the gold-silver ratio was averaging at around 30, not up at 80, where it's an extreme bargain. Now, if you buy at 80 and you convert to gold at 40, you're getting twice as much gold as you paid for. If it goes to 20 and you convert, that's 4 times more gold than you paid for. And if it does go to 10 and you convert, you're getting 8 times more gold than you paid for.
Gold and silver are setting up for what could be the most dramatic move of our lifetimes. With gold's trajectory pointing toward $10,000 an ounce and silver potentially surging to $500, the gold-silver ratio is signaling a rare and powerful opportunity. Historically, when the ratio has been at extreme highs, those who accumulated silver and later converted it into gold at lower ratios multiplied their holdings many times over. Today, with the ratio still elevated, the setup is once again presenting itself. Unlike the 1970s and 1980s, this time the backdrop includes global debt at record levels, persistent fiscal deficits, and structural shortages in silver supply. The stage is being set for a flood of capital into precious metals that could reset valuations across the financial system. Mike Maloney, a longtime educator, investor, and author in the precious metals space, emphasizes how silver's leverage over gold makes it one of the most asymmetric plays in today's markets. Now, we present the clips from Mike Maloney's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Here is a 3-month chart on my website, goldsilver.com. And this is the breakdown that he's talking about. And it ended up at 81.53. And so that's the breakdown, 3 months of ratio action. But that time frame is 3 months. Let's go to all data here, which takes us back to 1994 or January 1995. And what you see here is that the average is really like below, it's 60 or below. And we're coming off this peak of 100. It was 120 during COVID. This is monthly data. So it's the average for the month. It's not or maybe it's the close of the month, but it's not daily data. If you could see this went over 120, if it was daily data, and this went down to 30. And so if somebody buys silver today at 81, and it drops to a ratio of 20. It was 14 in 1980 when gold and silver peaked. And if it goes down to 20, which I am expecting it to blow right through. I do expect 20, and I am going to be doing this at 20, where you convert some of your silver to gold. But I'm expecting this time. So see, back in 1980, there were huge government stockpiles. We didn't have shortages on the commodities exchange, and well, there was on the commodities exchange, but everywhere else in the world, there were stockpiles of gold and silver. There wasn't a structural deficit where we're using up more silver and throwing it away year after year after year than we are mining, shrinking the stockpiles to critically low levels. There wasn't the levels of deficit spending. There wasn't a currency crisis coming, and I believe there is. And so there wasn't these crisis levels that are going to drive the silver price as people rush into silver more and more and more, and as the media starts covering it more and more and more, when it starts setting these all-time highs, and as more of the mainstream analysts and companies, like you saw TD Securities and you saw Morgan Stanley, they're talking about this now, where they weren't before. As all of this starts to happen and people start to pile into silver, this is going to go down. I do think that somewhere 5,000 is an absolute minimum for gold, but I think that's even silly. I think we're going to be seeing $10,000 gold. Well, at a 20-to-1 ratio, that's $500 silver. And nobody thought that a gold-silver ratio of 14 was achievable. But when the bull market in the 80s the 70s started, the gold-silver ratio was averaging at around 30, not up at 80 where it's an extreme bargain. Now, if you buy at 80 and you convert to gold at 40, you're getting twice as much gold as you paid for. If it goes to 20 and you convert, that's 4 times more gold than you paid for. And if it does go to 10 and you convert, you're getting 8 times more gold than you paid for. Why would anybody buy gold right now? I mean, I let this dictate to me what I buy, and this is how I ended up with 300 ounces of silver for every ounce of gold that I owned. When it went down here below 50, I wasn't buying any silver. I bought only gold there. But I used to make monthly purchases, and every time it was above 70 or 80, I was buying only silver. And that's why I ended up with so much silver. So if you measure currency, we were at, in the book, it was $7.5 trillion, and it jumped up to about $10 trillion in the United States. But when you add all the other currency on the planet, you're talking about $80 trillion there. And then $125 trillion of stocks and $145 trillion in bonds. Morgan Stanley says of which you should liquidate 50% of it and transfer that into gold so that you've got a 60-20-20 portfolio. And anyway, this plus this plus this plus this ends up at 350 trillion. And so 1% of that is 3.5 trillion, not 200 billion. And so we're talking a whole nother level of thing happening here. The explosion that we are going to see in precious metals, $10,000 gold is almost like a silly low price. I said 5,000 earlier, but that's 5,000 is absurd. That's not even on the table. $10,000 gold minimum is like a destiny. Now, gold can go up, and then to save currencies around the planet, they can come up with a new world monetary system based on gold and peg it, and it'll stop. Silver will go into a super spike and then probably come back, but silver is still going to give you this giant leverage. So let's say, 1% of each of these, that's 3.5 trillion, let alone this new mix of 20% bonds, 20% precious metals, and 60% stocks, which would mean liquidating half of the bonds. This is an absolute flood. Now, when I first started buying silver, this is a chart of 2002 and 2003. I started buying gold back in October. It was $315 an ounce at spot price when I made my first purchase. I made my silver purchase in April at about $4.38 an ounce, and I made another purchase at $4.50 roughly. And back then, at $4.50, the coin shops were empty. I walked in, I was the only person in there. I was in there for a few hours. The only person there. And so it sort of looked like this. At $4.50, there was nobody. Move the decimal 1 point over to today, and at $45, there's a trickle. There's a few people. I wasn't a precious metals dealer then. I was just an investor, a buyer, just starting. And now I am a precious metals dealer, so I know how much sales is happening, and it is just a tiny little trickle. But let's move the decimal one more time because of the news media constantly pummeling these people with, it really will be month after month at first, and then week after week, and then day after day. They're going to be hearing about silver, and people will come flooding in, and that is what is required for this super spike to happen. Silver is mostly an industrial metal most of the time, but there are these rare moments in history where it becomes the safe haven investment. It becomes money once again. There's monetary demand to preserve your purchasing power, your wealth. And so how does the powers that be, the commodities exchange and all of the government, how do they control this? How do they try to keep this from happening? Well, what they do is they raise margin requirements. They did this a bunch of times in the late 70s and the first January of 1980, and they lost control of it. They could changing margin requirements constantly, that and then position limits, and then finally liquidation orders only for silver. the CME raises gold margins by 6.3% and silver by 6.7%. Now, what happens when you raise margin requirements? This is on futures that we're talking about. So you've got the commodities exchange trading all these futures contracts, paper, silver, and gold that does not exist. They just make it up, and it's highly leveraged. So at times, there might be more than 300 ounces of paper silver floating around for each real ounce that's in the vaults that's deliverable. But when they raise this by 6.7%, you either have to come up with that cash if you're leveraged out to the max on your margin, or you've got to liquidate that much of your position to get within their limits. And so this time, though, they're going to lose control of it just like they did last time. The last time they lost control of it, and it exploded in the final months of 79 and the first month of 1980.
Silver is once again approaching a critical threshold, trading just under $4 from its all-time highs. This moment is not only technical, but deeply psychological. Once the mainstream media begins reporting daily on new silver records, momentum could shift rapidly. While many in the US still view silver priced in dollars, other currencies are already showing record-breaking strength. In Japan, for example, silver has surged past all historical levels, confirming its breakout across multiple timeframes. Technical formations, such as the long-developing cup and handle, now project much higher price targets, potentially into the triple digits. Despite this, sentiment in the West remains subdued, with little retail enthusiasm compared to past bull markets. Analysts highlight critically low inventories, particularly in London vaults, where freely available silver stockpiles may be exhausted within months. Once shortages become undeniable, price moves can occur in an explosive gap fashion, jumping from $55 to $80, then to $100 or more, leaving latecomers behind. Major institutions are already revising portfolio strategies, reducing bond exposure, and pivoting into hard assets. Silver's tiny market size means even a modest wave of capital could create disproportionate price shocks. Let's get back to the interview.
Last week, silver closed above 46 at 46.05 on the close and 46.63 intraday. We are less than $4 away from setting record all-time highs. And what that means is we are less than $4 away from silver being in the mainstream media news every month, then every week, then every day, just like it was back in 1980 when it was going ballistic back then. So this is measured in US dollars, though. US dollar has been strong. What about the rest of the world's currencies? Some weak currencies. Here's the Japanese yen, and Silverhand says silver's price in JPY keeps smashing new all-time highs, but the media is crickets on it, and they are. This is interesting. You can see the cup and handle formation here that we were developing from 2012 through 2018, I think it was, and then that cup and handle completed, and it started taking off like a rocket. And I said that this would be a silver slingshot, and man, it was, especially in other currencies. But we are setting record highs in these other currencies. So this is what the rest of the world is looking at. We're in this bubble in the United States, and we only look at things from our point of view. So silver's here's the performance for the last 2 years. So 2 years ago, silver, the stock market is up 55%. Gold is up 105%, but silver is up 120% in the last 2 years. And then year to date, the stock market is up 12%, gold is up 42%, silver is up 55%. Here's that beautiful cup and handle formation. If we look at it on a daily, like I said, we're less than $4 from completing this cup and handle that is projecting, way up in the triple digits. I do not know exactly where. I'm not the greatest technical analyst, but I see a lot of people do this. I've been doing it for years myself, and I was the first one to recognize this 45-year cup and handle. So this cup and handle is what we were all paying attention to, and it broke, and we had the silver slingshot that I was talking about, and it continues. But this is a daily, Here's the weekly, not much different. It's almost the same. And then here's the monthly. We've already had confirmation and a breakout on the yearly and the quarterly. And like I said, we're like $3 and something away on the monthly. You know, we still have a whole quarter left to go this year. We could be seeing record all-time highs. Yeah, I'm talking about 5,000-year all-time highs for silver within just a few weeks here, or even less. I mean, it leapt almost $1 on last Friday. So moving on, the thing is, it's doing all of this without any excitement in the West. Where is all of this coming from? Make gold great again, says gold and silver retail buying sentiment check at Sydney's largest bullion store. No queue, no fear of missing out, no nothing. The fleecing will continue until morale improves. Well, morale, it's coming up for silver stackers. A lot of silver stackers were depressed for quite a while, but their morale is improving. It's going to, the fleecing will continue until the public's morale deteriorates into panic. And then you're going to see armed guards at this door and a line stretching around the block, just like it was back in 1980. I want you to listen to this. This is from James Anderson, but Danielle Gali, I think it is, of TD Securities. So this is TD Securities, major brokerage firm on silver near 44. This is a couple days old, so it was still around 44 then. We're over 46 now, but I want you to listen to this.
Any thoughts on silver? We know it's an industrial metal, yada, yada, but a much smaller market than gold. Is it likely to outpace its big brother, do you think?
We think this is the end game of what we envisioned for silver. If you recall, Andy, we've spoken about this quite a few times. Mm-hmm. This is what we saw as the silver squeeze you can buy into, which is really premised by a drain in London vaults, free-floating inventories of silver. We think that drain has now reached a level that is critically low, meaning that at the average pace of ETF inflows over the course of historical cutting cycles, there are probably less than 4 months remaining until the LBMA's entire free-floating inventory stockpile is depleted. That means that the risk of gaps in prices is more elevated, liquidity is critically constrained, and every further drain from current levels should be supportive for prices and at a convex fashion, meaning at a faster and faster fashion.
So he's talking about convex prices. He's talking about it going up in a convex fashion, exponential. He's talking about gaps where it goes to 55, the public starts charging, it jumps to 80 with a big gap in the chart, and you don't have a chance to buy in that area. And then the next day it jumps up to 100 and so on, which is entirely possible. So mainstream is just starting. So Ben Rickert says the traditional 60-40 portfolio is dead. Morgan Stanley recommends liquidating 20% of bond allocation and converting it to gold. So actually it's 50% because it's a 60-20-20 portfolio. So if bonds were 40% and you're liquidating half of them, that creates the 60-20-20 portfolio. So liquidating is actually half of your bonds that Morgan Stanley is recommending that people do. Now, this says converting it to gold. It doesn't say silver. So silver may still lag a little bit, but eventually all these people are going to be finding out about the fundamentals of silver. And so this is really, really huge. David Bateman, I bought $400 million worth of gold last year and bagged a measly 0.001% of the annual global gold mine output. I also bought $400 million worth of silver and purchased 1.5% of annual global silver stock, 1,500 times more percentage-wise. Do you get why silver is passing up gold now? It's the most coveted resource on Earth. Not yet, David, but it will be. Far greater demand than gold. On a percentage basis, judging, which you say in the next statement, but I want to be clear for the public. The gold has a far, far greater demand than silver, and it's by many, many multiples right now, because silver is a minuscule, microscopic market that just cannot take very much cash flooding into it.
Silver's story is unfolding into something far larger than a simple commodity trade. The technical picture is aligning with structural supply shortages and a global awakening to its role as both an industrial necessity and a monetary refuge. We're seeing record highs in foreign currencies, vault inventories under extreme pressure, and mainstream financial institutions only beginning to acknowledge what dedicated silver analysts have been warning for years. This mix of fundamentals, market psychology, and institutional rotation sets the stage for a truly historic revaluation. The reality is apparent. Silver is not just another asset on the margin. It is a pressure valve in a financial system overloaded with debt, leverage, and diminishing trust. When the inflows accelerate, the moves will not be gentle or incremental. They will be violent and exponential, leaving only those positioned early with the full benefit of what's ahead. That's why it's crucial to stay engaged, keep learning, and prepare before the rush becomes undeniable. The signs are already here, but the real flood has yet to begin. If you found value in this breakdown, make sure to like this video, subscribe to the channel, and share your thoughts in the comments. Your perspective is what makes this conversation stronger.